Ladies and gentlemen, good day and welcome to the Q2 FY23 earnings conference call of SBI Life Insurance Company. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on the touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Mahesh Kumar Sharma, Managing Director and CEO, SBI Life Insurance. Thank you, and over to you, sir.
Yeah, thank you very much. Good evening, everyone, and we heartily welcome you all to the results update call of SBI Life Insurance for the half year ended September 30th, 2022. The update on our financial results can be accessed on our website as well as on the websites of both the stock exchanges. I have along with me Sangramjit Sarangi, President and CFO, Ravi Krishnamurthy, President Operations and IT, Abhijit Gulanikar, President Business Strategy, Subhendu Bal, Chief Risk Officer, Pritesh Chaubey, Appointed Actuary, and Smita Verma, SVP Finance and Investor Relations. Now, let me give you some key highlights for this half year ended 30th September 2022. New business premium registered a growth of 27% YOY and stands at 130.9 billion, leading to private market leadership. Individual new business premium stands at 84.6 billion with a strong growth of 31% and private market share of 25.3%. Gross written premium stands at 279.7 billion, a growth of 21%. Protection new business premium grew by 32% to 16 billion. Profit after tax stands at 6.4 billion, 36% growth over corresponding same period last year. Value of new business is 21.2 billion, registering a strong growth of 53% over the 13.8 billion in September 2021. VNB margin is at 31% with an improvement of 630 basis points over 24.7% in September 21. Embedded value of the company as of September 30, 2022 stands at 424.1 billion. Assets under management grew by 16% to 2.83 trillion. Robust solvency ratio of 2.19 as against the regulatory requirement of 1.5. I would also like to highlight a few key initiatives taken by the company. Considering the various requirements of the customers, we have launched SBI Life Retire Smart Plus product, which is a unit-linked pension savings product. This product offers a comprehensive range of pension savings with varied fund options with an option to defer the vesting date as compared to our earlier version of Retire Smart, which didn't have this feature. We have a view to broaden, with a view to broaden our reach. SBI Life has tied up with India Post Payments Bank Limited, a leading bank in rural markets. With this, we will be able to enable our customers, especially the section living in unbanked, underserved areas, to become financially secure and empowered. We now update you on each of the key elements. Let me start with the premium. Individual new business has grown to 84.6 billion with a growth of 31% YOY. Single premium contribution is 32% of individual new business premium, which can be attributed to growth in our individual annuity product. The company gained private market share of 196 basis points to reach 25.3% market share. On individual rated new business premium, we stand at 60.5 billion with a growth of 21% and private market leadership with a share of 23.7%. Also, group new business premium stands at 46.3 billion with a growth of 21%. In all, we have collected total new business premium of 130.9 billion, registering private market share of 22.6%. Renewal premium grew by 16% to 148.8 billion, which accounts for 53% of the gross written premium. To sum up, GWP stands at 279.7 billion with a growth of 21%. In APE terms, premium stands at 68.3 billion, registering a growth of 22%. Individual APE stands at 61.2 billion with a growth of 22%. During the half year ended September 30, 2022, 9.2 lakh new policies were issued and this registered a YOY growth of 21%. Individual new business sum assured registered a growth of 14% over the corresponding period last year, which is compared to a growth of 7% at private industry level. Considering our robust performance for H1 FY23, we continue to expect healthy growth in our performance in H2 FY23. Let me give you details about the product mix. We are happy to report that the company has steadily moved towards a more balanced product mix. So on a half-year basis, our guaranteed non-par savings products are contributing 20% of the individual new business, and on APE basis, this constitutes 26%. Non-par guaranteed new business has registered a growth of 221%. A growth of 221% YOY, mainly due to the new business contribution of Smart Platina Plus, which is 12.69 billion in the half year ended September 30, 2022. This product was launched in March 22 and has seen a strong traction in the new business premium, mainly due to the product features which are having a high in the market. ULIP has remained one of the flagship segments for the company. Individual ULIP premium is at 43 billion, which now constitutes 51% of individual new business premium. Individual protection is at 4.3 billion, registering a growth of 17%. Group protection stands at 11.6 billion with growth of 38%. Credit life new business premium has grown by 36% and stands at 9.1 billion. On APE basis, protection contributes 11% of the new business and has registered a growth of 23%. Annuity business is at 19.8 billion and contributes 15% of new business premium. Under annuity, the company is offering immediate as well as deferred annuities. Individual annuity business is growing at 136% over the same period last year. Total annuity and pension underwritten by the company is 32.8 billion, registering a growth of 7% over the half year ended September 30, 2021. Group fund management business is at 31.1 billion with a growth of 39%. On our distribution partners, with a strength of more than 54,000 CIFs, SBI and its RRBs bank assurance business contributes 67% and grew by 38% in individual new business premium. And on individual APE basis, it stands at 41.3 billion with a growth of 24.5%. Agency, our other major channel, registered a new business premium growth of 24% and contributes 18% in new business premium. Agency channel individual APE stands at 17.1 billion with a growth of 12.5%. As on 30th September 2022, the total number of agents stands at 1,78,357. During the half year, the company added nearly a net of 32,300 agents. During the half year, other channels grew by 52%, which include direct corporate agents, brokers, online web aggregator, etc., and 45% in individual APE. Protection new business premium through other channels registered a growth of 38%. Partnerships like Indian Bank, UCO Bank, South Indian Bank, Punjab Singh Bank and Yes Bank registered a growth of 62%. These partnerships have started contributing 3% of the individual new business premium. On profitability, the company's PAT for the half year ended 30th September 2022 stands at 6.4 billion with 36% growth YOY. Our solvency remains strong at 219% as on 30th September 2022. Value of new business is at 21.2 billion with growth of 53% YOY against 13.8 billion in the corresponding period last year. VNB margin is at 31% vis-a-vis 24.7% in H1 FY22 with an improvement of 630 basis points. We have aligned the value of new business and VNB margin for half year ended 30th September 2021 in line with 30th March 2022 disclosures. Growth in VNB margin is fueled by change in product mix with predominantly non-par segment has contributed, and of course the business volume. With our growth targets and the product mix shift, we expect to maintain a healthy VNB and VNB growth rates. Coming to operational efficiency, OPEX ratio reduced to 5.6% for the H1 FY23 from 5.8% for the similar period last year. Our total cost ratio stands at 10.2% for the first half compared to 9.5% for the last year same period. With respect to persistency of individual regular premium and limited premium paying policy, 13-month persistency stands at 85.2%. The company has registered a significant improvement in 49-month and 61st-month persistency by 276 basis points and 363 basis points respectively. We have witnessed improvement in persistency ratios across all the cohorts. As mentioned in my opening remarks, assets under management stands at 2.8 trillion as on September 30, 2022, having grown 16% as compared to September 30, 2021. The company continues efficient use of technology for simplification of process. 99% of the individual proposals are being submitted digitally. 43% of individual proposals are processed through automated underwriting. To conclude, we continuously endeavor to maintain our leadership position and continue to further increase our market share by offering innovative products that meet the evolving needs of our customers. With our widespread, robust distribution network complemented by digital technology, our innovation strength, and above all, our people power, we are well placed to make the most of the abundant growth opportunities offered in India's underpenetrated insurance sector. We will continue to leverage existing partnerships and explore new partners and launch new products to meet customers' needs. Thank you very much for patient listening, and we are now happy to take any questions that you may have.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Swarnabh Mukherjee from B&K Securities. Please go ahead.
Hi, sir. Thank you for the opportunity and congrats on a good set of numbers. I have a couple of questions. First one, I would like to have your comments on how do you see growth panning out in the second half, given that you have a focus on diversification now, and what I think the expectation is that ULIP will now be slightly lower proportion of the mix than it used to be earlier. Given that these generally the average ticket size would be higher than the rest of the product segment. Or correct me if I am wrong in case that is not correct. So how do you see growth panning out in AP going ahead for the second half? That would be my first question. Second is on the margin side. So this particular quarter sequentially there has been an increase in contribution for units, and that has been, I think, the major change in the product mix, along with non-pars contribution also going down slightly. So despite that, we have seen an expansion of the margin. Just wanted your thoughts on how to read into this. Is this again a function of the cost ratios being lower this quarter? How should I look into this? And what is the operating assumption change that has been shared in VNB? If you can throw some light on that. Those are my questions, sir.
Yeah, so, if you are looking at growth for the second half, our second half has always been very, very strong. So, if you see historically, Q3 and Q4 are extremely strong for SBI Life, and we don't imagine that there is anything that should actually change all that. So, our own projections are based on our historical trend of Q3, Q4 being the strongest quarters for us. So we look forward to a good, robust growth there. I have been maintaining earlier also. Sorry.
Yeah, sir, please go ahead. I just wanted if you could quantify, what would be a growth guidance for the year at least.
Yeah, so I have already said earlier that we would like to grow at 20 to 25%, and that remains, and we are working towards that. I think directionally we are going right, and like I said, Q3, Q4 being strong quarters for us, we are very confident that we'll be able to achieve our projections. ULIP, I have said earlier also I think I remember in all my earlier calls I have said this, that ULIP growth will be there. We see a lot of traction already happening for demand for ULIP, and ULIP will also continue to grow. Obviously, the non-par product that we have launched was a super hit with our customers, and as a result of that, it appears as if the focus is slightly off ULIP, but ULIP will continue to grow because it's a very, the products that we have are very customer-friendly products. You will also recollect that I just said about a new product that we have launched, Retire Smart Plus, and that's also a unit-linked product, and that is also expected to do very well going forward. So I think the growth and the whole idea about ticket sizes and all, you are right. The ticket sizes of non-ULIP products may be slightly lower, but then our own idea is that ULIP will also continue to grow in according to its usual pace that we grow with. At least that is the minimum that we would expect it to grow, and therefore we don't see any major reduction in ticket sizes or in our ability to meet our targets. Last question about the VNB margins. Yeah, you were asking about margins. How come the margins are continue to be robust, even though I think you said that non-par has gone down or something like that? No such thing has happened. Non-par has grown.
Sir, non-par in the mix, I was pointing towards the mix change. So non-par share in the mix.
If the volume grows, obviously that thing is going to be there. The contribution is going to be there. So the volume has grown overall. So if you see the growth, non-par has grown in this quarter.
Also, just to add what our MD sir mentioned, that you may see some slight reduction in this quarter in the non-par saving. But within the non-par saving, it also depends on the combination, because there are several non-par products which having the higher margin. Even the new product that last year we have launched, they have a different option, and each option has a different margin. So there is a shift happening on that part. So we are able to optimize those margin within the non-par. And also, in case of annuity, we have the deferred annuity on individual platform, which we launched subsequently. And that's also helping us to enhance our margin. So if you see, that's contribute and help us to maintain the margin that at current level.
So just to clarify, the product mix change is only 2% compared. So the other product mix had moved from non-par to ULIP only by 2% in this quarter. So it's not very material change. And Pritesh had answered the remaining part.
Yeah, sure. So that's very helpful. Just a follow-up on the growth side, sir. The growth number guidance that you gave, is that on APE basis or NBP basis?
You can take it on APE basis.
Okay, sir. That's very helpful. Thank you so much for your answer, sir. I wish you a happy Diwali.
Yeah, thank you. Wish you a happy Diwali.
Thank you. The next question is from the line of Deepika Mundra from JP Morgan. Please go ahead.
Hi, sir. Good evening. Sir, just I believe that on the VNB side, on the base number, there has been some restatement, right, for 1H22?
Correct.
Yeah. Sir, could you give us?
What we have done is, whatever we had projected in March 22, that same methodology we have used on September 22. So September 21. So you'll remember that we had we were stating on a different basis, and we changed the methodology in March 22. And so to compare the September 22 figures, we have done the same thing with September 21 and come up with these figures. So 24.7 that you are seeing is as per the new methodology.
Right. So could you help us with this, that breakup for June 21 and September 21, or if you have it handy?
The what? Breakup of what?
Sorry, the second quarter number for in terms of the VNB margin, which equate to the 31.5 under the same methodology.
We don't have we can calculate and give it to you, but I don't think we have it I don't have it at this moment.
Right.
Pritesh will answer. Yeah.
Okay. So see, earlier. What Mr. mentioned that earlier we used to show the base number and then you used to give some sensitivity and effective tax things that we have modeled subsequently in the month of March, and model was reviewed by TW that point in time. So what we did that just to be comparable number, we have rebased those numbers, and that's the reason it becomes 24.7, and hence we are comparing our VNB margin growth from 24.7 to 31%. Now, if you look into June as well, June as a Q1 earning call also we have rebased same approach. So while June opening number was 21.2 on base, we have restated to 23.7, and closing number for 2022 was 30.4. So if you want to compare the comparative number, for June 21, the rebase number was 23.7, and for September 21, it is 24.7.
Okay, so very clear. So just a question on the EV sensitivity. It has gone up to 4 in the first half of the year versus I think 1.8, which was in FY22. Any clarification on that? What is driving the higher sensitivity in EV?
So this is
for interest rate.
So this is basically on the base effect. So if you see the mark, if you see the yield from the March to September has gone up significantly, and when you do the sensitivity from current level, base has changed, and as a result you see higher sensitivity coming from the interest rate side.
So sorry, would you mind elaborating a little bit on that?
So what happens? Suppose your yield is on 31st March was lower, and when we do the sensitivity for 1% up, you do the sensitivity from that level. What happens from the March to September, yield has gone up, and if you look into the shorter duration, yield has gone up more than 100 basis points, and as a result, there will be MTM losses coming from as compared to the March 2022, and that will become your base. And when you do sensitivity, you start with the lower MTM base. As a result, you see the base number will get changed. The major contribution coming from those funds, including particularly the shareholder fund, where there is no corresponding liability. So while other LOB has the corresponding liabilities, will get offset on that basis. In shareholder fund, there is no subsequent liability, so all MTM will impact your sensitivity. Subsequently, if you also look into this discounting, because the EV is a run-up business of future, and initial year your base has increased. So when it's not linear impact on the value of in-force business or EV. So when you go and start looking into the higher number, the impact will be different, and that's the reason you see higher sensitivity coming up.
Okay, sir. Thank you very much.
Thank you. The next question is from the line of Avinash Singh from Emkay Global. Please go ahead.
Yeah. Hi. Good evening. So the first question, I mean, of course, numbers are too good to ask much, but in terms of improvement, I mean, of course, you have hired a good amount of agency workforce over the last 1-2 years. Now, at this juncture, I mean, what kind of productivity improvement? I mean, how do you see the growth across agency channels comparing vis-a-vis banks that, of course, have been filing? So that is my one. That okay, what are your sort of plans around agency, and how do you see this performance improving? That's one. And second, within banca, I mean, ex SBI, what would be the contribution? Because some of the public sector banks, I think we are already almost with them for 2-3 years now, and they have of course, a large network as well. So what are overall ex SBI contribution in the banca? These are my two questions. Thank you.
Yeah, so agency, you are right that we have recruited. So what has happened is that in the COVID, basically there were a lot of agents who were not able to perform, and we had not actually removed any agents from our rosters in the last, last year only we started that process once again to rationalize the numbers. So, but what we have done is we are going all out to get more and more agents and to increase the agency business. So, as you can see, we have the biggest agency in the private sector by a long margin. And our productivity, per agent productivity is 2.5 lakhs. I don't think anybody else has got anything near that. And this is what we would like to grow. So, and it can go higher also. There's already been a growth of about 6-7% in productivity. But I think there is a lot of scope there. And plus the numbers, if you see the net numbers have gone up by 32,000, and this is not my target, we are targeting a much higher number. So once these agents, in the same proportion start getting productive, I'm sure agency will contribute much more in the future. The other question regarding the non-SBI banca, so I can say that, right now they got 3% of the business comes from these banks. And our idea is that this should go way up, because if you look at the way SBI has grown, if these public sector banks partnerships that we have, if they can only take that same trajectory, I think the growth is going to be huge. But having said that, you will notice that these relationships have grown by much bigger amounts. So almost 63% growth across the other partners. So that's something which we have already achieved.
Okay, thank you, sir. Wish you a happy Diwali.
Thank you. The next question is from the line of Neeraj Toshniwal from UBS India. Please go ahead.
Yes, sir. Wanted to understand our outlook on last quarter we spoke about that we'll be looking for passing on some benefits in terms of over the course of time. So where are we and how much would that lead to, if any, effect on our margin expansion? That is the first question. And second is on the Bima Sugam. Wanted to know that we are not too active on third-party aggregator platform, but would there be any change of strategy with the opening of this online exchange by the regulator?
Yeah, so see, outlook on interest rates, it's basically a thing that we keep calibrating. Now, if you look at the movement of the interest rates, you really don't know whether there are going to be any more interest rate hikes. So, this is something which we are looking very closely. And the product itself has got a very good demand that we have, the non-par guarantee. The guarantee that we are offering is finding very good uptake. Right now, we are evaluating, so we'll see how it goes. Obviously, if I increase the guarantee rates, the margin is going to go down by that much amount. There is no way, you can increase the interest rates paid to the customer and increase the margin. So that is not happening. But we'll keep close look on the interest rate movements and decide whether we want to do any such thing. Obviously, the customer is king, and if the customer will buy only if there is a higher guarantee, then obviously we'll reprice and we'll give a better guarantee there. Bima Sugam is a good initiative by the regulator. I think IRDA is going in the right direction with that kind of a thing. I think we'll have to see what the contours of the platform are going to look like, and what kind of business can happen out there. But prima facie, I think it's a very good idea. And we were not on these earlier platforms because they were very expensive to be on, frankly speaking. So I don't think it has got anything to do with our reluctance to be on a public platform. But we don't like to be on fixed platforms. So platforms which are fixed by somebody else. So therefore we were reluctant to be on other platforms. But Bima Sugam coming from the regulator and having all the right credentials, I don't think we will have any hesitation in going all out on that platform.
Okay, sir, got it. That was very helpful. Thank you and all the best, sir.
Thank you. The next question is from the line of Anirudh Shetty from Solidarity. Please go ahead.
Yes. Hi, sir. Thanks for taking my question. So my first question was on our non-par book, and it's grown quite well. I just wanted to get a sense of, do you all see enough availability of hedging instruments to keep growing this book at the pace that you all would like to desire? And also, typically, what percentage of this book is hedged for us? And also, could you give a sense of what is the average tenor for this book, and how much would be deferred and how much is immediate?
Yeah, so the availability of hedging, obviously, we would like to hedge any kind of such a guaranteed product. We can't go ahead without hedging unless you have a crystal ball and you know exactly how the interest rates are going to behave. So, failing to do that, we would like to hedge, and we will continue to hedge so long as the availability is there. So, right now we don't see any problem with the availability, and we are able to hedge to the extent that we want to cover. And I wouldn't like to give any percentage out here. It's something which we do at our end. But suffice to say that we are well hedged to take care of the uncertainties of the nature of the product. It's a long-term premium paying product, so it goes from 7 to 10 years, and therefore we are properly hedged there, and we would like to continue to be hedged there, and right now we are able to get what we want.
Got it. And sir, there's a lot of opportunity to grow within the SBI branch network. Can you just give a sense of what is the share of branches that are activated? What is the long-term number that we think we can kind of get to at? And I think
almost all branches of SBI are generally active. So it may vary from month to month, but on an average, all the branches of SBI would be active, with some minimum number of policies being sold. So that is something which contributes to our growth in SBI, and that has been very steady, if you can see, over the past.
And see, our number of just under 40 lakhs per branch is what we have achieved, and which is lower number than some of our leading private competitors. We hope to bridge that gap over years.
What do you think is the right, that was very helpful. What do you think is the right, this productivity of 40 lakhs, how do you see that trending over time? Like, where do you think, what is a more healthy number that you guys aspire to?
It can go up. See, what happens is, in India, it is not a question of the availability of people who need insurance. It is a limit of the people to understand that they need to buy insurance,
Mm-hmm.
So you keep talking to people, and like any sale, you talk to 100 people, you get 2-3 sales. So in insurance, it is it is probably on the lower side there. So you have to talk to a lot of people. It is not a very easy conversation to have, So when you start the conversation saying that, suppose you die tomorrow, who will take care of your family? It's not a very easy conversation to start. So that is why insurance business in India is taking a little while to actually reach that penetration level which is there in many advanced countries. But having said that, there is huge scope. So, there is a lot of scope. And if you ask me, I will tell you the global figures. Overall figures that you see, there is a 82% protection gap in India. So the amount of protection that Indians need overall, only 18% of that is fulfilled. So, you know the kind of potential that exists out there. And that's true of SBI customers also.
Absolutely, sir. And one final question, typically at these SBI branches, how many SBI Life employees would be stationed over there as a rule of thumb?
Yeah, so I would like to say, but every branch would have one person who sells, who should typically be able to sell insurance.
No, so what happens is we have support given to each and every branch of SBI. And unlike other players, we have multiple branches being handled by one BDM. Of course, there are some...
No, not our employees. He's asking about SBI employees. He's asking about... No, SBI employees. You are asking about SBI employees, no?
No, sir. SBI Life employees.
No. SBI, I'm sorry. I was talking about SBI employees. Typically, there should be one per branch, at least. That is the minimum that we need. And in bigger branches, there would be more. Our own employees, we have a very different kind of structure. So there would be about one employee per 10 on an average, per 10 branches on an average. But that can change, depending on the distance and all. For example, in Northeast, I can't say that I'll have 10 branches covered by one person because the branches may themselves be 100, 200 kilometers away.
But do you see the need to add more here? Because, like you mentioned, protection is a tough product to sell. So, do you think by adding more of the...
See, the whole idea of our model and why our model is cheaper is because we are following the regulatory instructions of the bank people doing the sale and our people training, hand-holding them, helping them with the sale process. So that is the model that we are following, and that is why we are the lowest cost. If I were to put one person per branch to sell from my side, then I would be defeating the requirements of regulation also, and at the same time it would be a very, very high cost model.
Got it. So that was my last question. Thank you for answering.
Yeah, thank you.
Thank you. The next question is from the line of Dipanjan Ghosh from Citi. Please go ahead.
Hi, good evening. Congratulations on a good set of results. Two questions from my side. One is, you alluded to the change in product mix within the non-par segment, which kind of supported the margins during the quarter. So would you like to throw some more color into the mix of the products in terms of policy term or customer age or tenure? And second, on credit life, you have last year you have been guiding that you are focused on increasing the attachment rates at SBI's counter. So what is the kind of progress that you see out there on that particular segment?
Yeah, so see, the non-par, I think, basically what Pritesh was trying to say is that, there are products and therefore, you can't really put a figure from outside on what it is. We do the exact calculations and then we arrive at the margins. So, the products, there are different products, there are different tenures. For example, even the non-par guaranteed product, it would have a 10-year 10-pay product, and there would be an 8-pay product, and there would be a 9-pay product or a 7-pay product. So, every one of these will be having different margins. So even a slight shift in those, that demand would change the margin. So, and really speaking, it's not a very big deal. What Abhijit said very clearly, there is only a shift of 2% in the overall mix, towards ULIP. And on top of that, the credit life has grown very robustly. And also, if you look at so that can be explained by the inter-product changes, in margin, etc. I mean, it would be very difficult. We would have to sit with an Excel sheet and talk about, how many of each of those products got sold and all that. We know that, but I don't think we can, we need to this on the call. But the other thing is credit life, like you say, yes, we would like to increase the attachment rates, and we have increased the attachment rates from 47 to 48% in the similar period. Last year we ended with 50% attachment rate, and this year we would want to take it much higher. I think SBI has also taken higher targets because they feel that this is a very good product for their customers to protect themselves and their families. And in fact, the product itself is called a Smart Family Product Protect. So this is something which I think we will try to increase the attachment rates.
Sure. Thank you and all the best.
Thank you.
Thank you. The next question is from the line of Sanket Godha from Spark Capital. Please go ahead.
Thank you for the opportunity. Sir, a bit of higher base impacted the growth in second quarter, and we also have a higher base problem in third quarter of FY22. So what makes you to tell you confidently that the growth of 20 or 25% can be achieved for full year? Because we had a decline in the second quarter, and if the same phenomena plays out in third, even if you grow by 20% or in the fourth quarter, still the guidance of consent seems to be tough to achieve. So just if you can give a little more color on that thing, it will be useful, sir.
Yeah, absolutely. You've got a very good question, but I think what you probably have ignored is that there was a peculiar circumstance in the last year in which you had April, May being totally washed out. So, that pent-up demand spilled over into part of it. Of course, everything doesn't get fulfilled because people forget, people don't buy, people don't fulfill, but part of it gets fulfilled in the next quarter. So that was the spike that I was talking about and not the normal spike. Normally, we have a seasonality which we take for the first quarter, the second quarter, the third quarter and fourth quarter. The third and fourth quarter, generally we take the highest seasonality because the numbers, the demand and the sale, everything happens in the second and third and fourth quarters. In fact, whole of India works on the basis of a busy second half rather than the first half. So the Kharif season is always less busy than the Rabi season. Okay, so that is where all the money comes. That is where all the harvesting takes place. That is where all the things happen. And as a result of that, the money flow, the demand, and especially the year-end demand, before the year-end, people want to do a lot of things within their budget. So as a result, naturally, during the last 2 quarters, there is always more activity. And last year also, it's not a question of the base. The base is only to explain the apparent lack of growth in the second quarter. If you look at the numbers, they are very robust numbers in the second quarter also. Only thing is when you compare it with the quarter of only last year, there is an issue out there where it is not showing a growth. But if you look at sequentially, it is a very good growth. So going forward, every quarter 3 and quarter 4 has been stronger than quarter 2. Always in the past for SBI Life. So that is where our confidence comes.
Got it, sir. And last quarter, in Q1 quarter, you mentioned that income plans of non-par, this Platina, contributed almost 30% of the total business. If you can put a color, how much it contributes either for 1 month or second quarter, and can I say when you said that the product within the non-par design helps in margin expansion, so is it higher contribution of income plans or higher spreads you made in the current quarter contributed to the margin expansion?
So non-par, I think, Pritesh, go ahead.
So you are absolutely right that non-par income plan has higher margin and that help us to enhance the margin as well. And you see this, depending on the premium paying term, we have the 7, 8 and 10. So 10 has higher margin. That's really help us. Now we have other non-par part which is endowment. And if you compare to the endowment versus the income plan, the income has high demand, and that's the reason this year, this quarter particularly, Q2, while we see this slight decline in the non-par proportion overall, the proportion has increased more towards the Platina Plus, which is income plan, and that's really help us to give this margin.
So what is that number, sir? Last quarter it was 30%. If you have that number handy.
Yeah, so 22 to 25, I think somewhere around.
So 20. If you see this quarter, it is around 25%. 25% approximately.
Oh, okay, got it, sir. And the another question which I had was, sir, you restated VNB based on the revised methodology which you applied for FY22 full year numbers. Can you restate the EV which you reported in 1H FY22 based on not based on the methodology you used in FY23? Because if I use that number of H1 FY22 what you have reported and look at EV growth, it looks muted 10%. So naturally the growth should be better than that 10 because assumptions were probably not appropriate in 1H FY22 on tax. So if you can restate that number would be very useful, sir. And related to it, wanted to understand how much EV got impacted in 1H FY23 because of MTM hit.
So see, we have not published our AOM from EV walk, and since we have not published our AOM walk, we have not restated number publicly. We are not quoting those numbers. In end of the year, for financial year, we will go and do that. So you get a comparison from March till next March. Because March number are only on the new base. Yeah. So we have not done that. So we don't want to quote those numbers at this point in time.
Okay.
And second question on your MTM as well, I think because again this is economic variance coming from that. So since we have not publicly disclosed those numbers, we do not want to comment on the MTM how much. But the moment you will see this, our MTM losses will be similar to the sensitivity that we shown in 31st March, not different than that. Second point is if you look into the EV growth, which you might be seeing is a muted. In the first 6 months of the year, EV growth of 10% is quite significant because most of the business will keep coming in the second half. So EV growth will be much higher, I believe. Third point, I think though we have not given the AOM, I can confirm that in operating variance, all the aspects including the mortality, expenses and persistency, we have the very positive variance. We are expecting even better because we have used a prudent assumption as our mortality is concerned, and we have not diluted our COVID provisioning as on 31st March 2022. We still carry forward. So by end of year, we see more positive operating variance, and you might be seeing more robust ROEV. But at that point in time, I think we have to wait till our year end. When March 23, we will do that.
Got it, sir. And the last one from my side. See, we are seeing improvement in the cost ratio. We are seeing improvement in the persistency. Our VNB, which is 31% for first half, is still based on last year cost and persistency. We have not touched assumptions yet. So even just wanted to understand that lever itself is still available for you to report a margin even better than what you have reported in 1H, sir?
See, I think we can expect that margin would be better in same product mix, but if you see the product mix might be changing over the next 6 months. So I think while margin will be more or less similar, I do see there will be some enhancement coming from, but I don't see any risk downside margin from the current level. Current level is not that exactly the 31%. We are looking for some range of 28 to 31% range. But definitely in the March when we revisit, we expect.
Yeah, so I mean basically this is largely conjecture because like I keep saying and I've said this. I know till I am also bored of saying it that we are basically selling products which that customer wants, and that doesn't change. I am not pushing anything down anybody's throat because it has got higher margins. Obviously, the margin will depend a lot on the demand that is there. But we will continue to give meaningful products to our customers, and they will find, they will find it useful. And as a result, we will grow our VNB, we will grow our EV. And margin, of course, will be a high, healthy margin.
Got it, sir. Thanks. That's it from my side. Thank you very much.
Thank you. The next question is from the line of Madhukar Ladha from Elara Capital. Please go ahead.
Hi, good evening. Congratulations on a great set of numbers. So most of my questions have been answered. Just I wanted your comments on the new draft regulations on commission and expenses of management. Our expenses of management are significantly lower than that 70% limit. I believe they're closer to 50-55%. So what I wanted to understand is how can this impact us, and could it lead to a scenario where our largest distribution partner and parent then demands for higher commission payouts? Your sort of thoughts on this.
I cannot speak for our distribution partners, but the whole idea is that a business is good so long as it is sustainable. And so long as it is, it's like nobody would want to kill the golden goose. Okay? So if you are doing good business and you are getting good, results out of it, good revenue out of it, I don't think you will want to kill the business by saying that you give me everything and leave nothing for growth. So I don't envy such a situation. First thing. Secondly, I think what is being attempted is, that there are a lot of companies which have been, constrained because of these regulations, and they would like to have more freedom in the way they spend the expenses of management. So I think that is where the regulator is looking at, giving some higher degree of freedom. But I am very, very confident that the regulator will still be looking very carefully at how it is being spent and how it is being managed, so that there are no wrong practices coming in. So I'm very confident that the regulator would think about all these things, and there would be a good framework for that. Having said that, we have never been challenged in terms of either EOM or commission payment. So we don't think it is going to affect us directly, but like you were saying, the scenario that you were thinking about, any such scenario looks like coming up, then we'll see what we need to do.
So while SBI may not take all of it as commission, but there can definitely be a scenario where there is some sort of payout increase. Have there been any discussions? Anything on that?
Yeah, I think this is all very conjectural. This is very, very conjectural. So I wouldn't like to comment on this. If there is something concrete that comes up, then we'll discuss this.
All right. So thank you. All the best.
Thank you. Thank you very much.
Thank you. The next question is from the line of Nitin Agarwal from Motilal Oswal. Please go ahead.
Yeah, hi. Good evening, sir. I have two questions on the annuity product. So first, what is really driving such strong market share gains in this business? I want to understand how important pricing is behind the growth of this product. Like you have always said that ROP product, the customers are not so price sensitive and they want money back in return. So how competitive this product is when it comes to pricing? And if you can also provide some color on distribution mix in respect to this specific line of business.
So annuity product, it is something which is very transparent, in the sense that everybody, person can go and search for annuity products and he'll know what kind of returns he'll get. So if I'm able to sell a product, it has to be competitive. So that's what we have. We have a very competitive product. and we are giving value for money, and that's why it's selling.
And all channels are selling.
All channels,
Both are selling annuity products.
All channels are selling.
Okay. And so how do you see the growth going further in this product as interest rate rises and banks are also increasing deposit rates, which can go up sharply?
So see, I don't think there is a direct connection between deposit rates and these products. Because, these products are totally different in structure. Deposit you will get for 3 years or maximum 10 years. Today you can get a deposit for 10 years and you can lock in the rate of interest for 10 years back. In an annuity product, you are getting for life. Okay, so that flavor is totally different. In the deposit, you get the money back and you have to deploy it again. So there are two things out here. One is liquidity, that you have the money, but again, you will have to deploy it. And there is no guarantee what rate you will get it in. So it is like euro. If you see, in the last 30 years, the rates of interest have gone down to zero and minus also. So if somebody imagines that, after 10 years, he'll put it in FD and then he will put it again at a better rate or something like that after 10 years, he may not get interest at all. He'll have to probably pay interest to do that. In an annuity product, I cannot afford to do that. I have to give him whatever I have committed today. I have to keep paying him till somebody certifies that he is no longer there. So there is a huge difference. I don't think that this is driven only by interest rates. It is driven by the returns that are generated and the guarantee. So you are able to give a guarantee that 50 years down the line, if you are alive, I will give you this much amount. Now that is what is driving that business, and I think it's a totally different demand and supply thing to fixed deposits or any other investment. You can compare it probably with a 40-year bond or something, but that's about it.
We do see a lot of growth in this annuity business, and particularly we see the
because most of India is not covered. Most of India is not
covered. Is maturing, so you'll get a lot of NPS will convert it to annuity products, and retirement is happening for the people who will buy.
Most people don't have any pension or protection.
So demographics, this is on a small base, but the fastest growing demography is people above 55, 60 years age.
Right. Got it. Thanks so much, sir.
Thank you very much.
Thank you. The next question is from the line of Anshuman Deb from ICICI Securities. Please go ahead.
Yeah, hi. Thank you for the opportunity. I have two questions. One is that, you mentioned you had a tie-up with India Post Payment Bank, and so has been the case for another leading private life insurers. So I just wanted to understand the competitive intensity around, the tier 2 net distribution or tier 2 kind of places. Has it increased? And, how comfortable is SBI sharing an open architecture with a leading private life insurer? That is question number one. And the question number two is, our sensitivity have increased, sensitivity interest rates. So, in terms of strategy, do we have a strategy to kind of lower it down or by changing the, but you mentioned about product being decided by the consumer, but, changing the product mix or changing other things to keep a control on the sensitivity to interest rates? These are the two questions.
Yeah, so see, when you are talking about open architecture and with private insurance, you are already in that kind of a situation with some of the banks. So we are already in competition with other insurers in 3 public sector banks and 2 private sector banks, apart from this ITTD relationship that we have just started. So there is no question about that. We are the leading insurer in all these relationships. So, we have the leading share in all these relationships. So I don't think we are bothered with open architecture per se. We have got a very strong brand name, we have got very strong products, and we have got very good servicing, and we've got a very good company. So I don't think we are bothered about that too much. And of course, we will keep pace with whatever developments are there. So coming to India Post Payment Bank Limited, basically the idea is that, these are this would expand our reach into the hinterland, into the deep rural areas, into the unbanked areas, the underserved areas. So, State Bank is one such medium. So we have about 23,000 branches, then we have about 9,000 branches of, I think, RRBs. And this is another attempt on our side to, cover all those black dark spots that we would like to think, where we don't have our complete presence in rural semi-urban areas. And this would help us to do that. And also in the urban areas also, then, we could probably expand this whole thing. The idea is that there are more than 600 branches of 635 plus branches of IPTV, which are then connected to all the post offices. So we are trying to have a model which we can then scale up. And this is not going to happen overnight. We'll work on it. But it's we think it's a very exciting opportunity. And for a country like ours, we have two purposes out here. One is, of course, to grow the company and to make sustainable profits and all that, increase the customer base. But very importantly, to develop insurance in India. We would like to be known as a company that actually grew insurance in India. So that is something which we will take a lot of pride in if we are able to achieve this objective of giving more and more Indians insurance cover.
Sure. And sensitivity, just to aid that we explained earlier as well, this is a sensitivity increase on account of the base effect, and particularly in the shift is not parallel shift because yield has gone up on cyber part, and so something happened on account of the fraud because we are writing guarantee product. Having said that, I think we should not be worried about the sensitivity for interest rate because this investment that we are making for held to maturity, and in case interest will go up subsequently, I think we will be able to make more money on the side as far EV growth is concerned. So there is no strategy that we are going to change our product mix. I think gradually we will be able to manage that.
No, but you have said it yourself very clearly, that the consumer is at the center, and therefore, there is no attempt to fix the whole product mix. What we would probably do is we'll try to introduce more products which will, find better acceptability with the customers to try to influence their buying decision, not the other way around, trying to push our existing product where they are not suitable. So first we find what is suitable for the customer, what he needs, and then we'll give it to him. And if his needs are slightly different, then we'll develop a product and give it to him.
Right. I was just coming from the perspective that you also said, right, for example, in the first half, if I were to calculate the economic variance, you said you can use the sensitivity to calculate it, right? So I'm trying to say,
Absolutely.
What I'm trying to say is that, let's say I'm projecting a 2-year EV, and I'm assuming let's say hypothetically a 200 basis point increase in interest rate, then your sensitivity is the highest, right? So I'm trying to say that on that perspective, as a business strategy, do we have a benchmark sensitivity that it should not go above that or something like that? Just wanted to understand.
Basically, the sensitivity is a construct. No? So basically, you use it to see what is likely, what could likely happen, in the unlikeliest case. Like, for example, the sensitivity is done on, say, plus 2%, minus 2% and all that. And that is not something which we are anticipating to happen in the next, say, 1 year or so. But if it does happen, what happens? So, a 4% sensitivity out there is, it may be higher than 2%, but it is still not something which will, affect the company negatively in the long run.
Just to add, there's two points I think we like to mention here. One is that our sensitivity, even 4%, is similar to our other peers as well in the market, so not very high sensitivity. Second point, I think you need to look into that. If you look into our public disclosure in the past, we have successfully able to reduce our sensitivity gradually in last 4 to 5 years. This, as we mentioned earlier, this sensitivity is at this point of moment, and that also reflects some of your movement in the yield curve and how the shape yield curve has changed. When anyone has to look into a longer term, I think you can look into March or even give a longer period. I'm not going to change the strategy because 6 months back our strategy and 6 months we not seen a lot of things. In fact, something impact coming from the FRA, but if you see other side, because non-par saving we're writing, we're getting parity value. So I think we are, the sensitivity is in our mind while framing our strategy in the product mix and other, though our choice is, first preference is to customer. At the same time, we always adopt a long-term view in each and every places that we mention, and hence we are not too worried about the short-term movement in the increase in sensitivity and interest rate. And that's the reason I mentioned that we should not be more worried about this sensitivity, particularly for the interest rate of scenario, because we are writing the product annuity with longer term. If you're able to interest rate, able to lock in these things, able to cope, even the unhedged book, if you're able to reinvest our coupons for the higher yield, ultimately is going to help us in the economic parity variance in future.
Thank you, sir. Thank you all, and happy Diwali to everyone. Thank you.
Yeah, thank you.
Thank you. Ladies and gentlemen, this was the last question for today. I would now like to hand the conference over to Mr. Mahesh Kumar Sharma for closing comments.
Thank you very much, everyone, for all the questions. You know, the questions that we get in the conference always keep us on our toes, and you know, it gives us an opportunity to understand our company even better than you know, we ourselves could. So thank you very much once again. Wish you all a very happy Diwali, and hope that going forward we all keep ourselves insured and safe. Thank you.
Thank you.
Thank you. On behalf of SBI Life Insurance Company, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.